welcome back. We're live now. Welcome back to my YouTube channel. All right, so we'll be continuing the beginners class. All right. Okay. Also, if you are new here, please subscribe, like, share, and so this is the era of traders FX free beginners class 2024. All right. Those of us that are here, we can share the link to the we can share the live um link on our status. Just share, also share to the group, share to anyone that you feel needs it, wants to watch the video. All right, um so what's forex trading? What's forex trading? This I want this session to be an interactive session, right? All right, so okay, so I'll mute somebody now. I think I can see Emmanuel. Emmanuel is here. Emmanuel, Emmanuel, can you help us? What's forex trading? What do you think forex trading is? And Emmanuel, or any other person can answer.
Okay.
Taiwo Collins. Okay,
Good
Emmanuel
afternoon,
is here.
sir.
Good
Good
evening. Good
afternoon.
evening.
Good evening. Sorry. Good evening, everyone.
Good evening.
So from my little understanding, I know that forex has to do with foreign exchange. So it is the
Okay.
trading of currency pairs. So when you trade two currency pairs, could be dollar to euro, and even later when um um Anointing was talking, I also got a deeper understanding that it's not just trading currency pairs, it's trading stocks. You understand? Stocks,
Yeah.
shares, all those things, all those volatility. So that's where all those boom and crash, all those things also come in as well. When you sell and trade these currency pairs, that's forex trading. So,
Great. Any other person? Thank you so much, Emmanuel, for that. Um, so like you heard, forex is foreign exchange. All right, foreign exchange is as simple as that. Foreign exchange is the exchange of currencies you trade. Okay, for example, let me just use this basic example. If you want to go to the US now, you can't use your naira there, so you have to exchange it. So that exchange rate you are saying, everybody saying dollar to naira, the exchange rate is 1,800, 1,700. That exchange rate is the price. All right, $1 to naira is 1,800 naira, $1, 1,800 naira. You get, so when you are exchanging these currencies, that's foreign exchange. But now you can do it, you can trade digitally. You don't need to go to US, you don't need to go to America before you can change your you can trade these things. All right. All right. So it's just basically understanding that foreign exchange is buying and selling of currencies, buying and selling. So it's trading. Trading is simply buying and selling. All right. So um there are some terms you need to understand for trading, all right? Buying, selling, buy, and all that, and all that, and all that. But before we go, before I want to, and like I said, you need to download your MetaTrader 5, all right? MetaTrader 5, MetaTrader 5, SNES, because we'll be using SNES broker, right? I sent my affiliate link to the group, so we'll be using SNES broker. Also, will be also Also, you need your trading view, right? You need your you need your trading view, to also trading view, and also what again? If you'll be trading derivative, which is the synthetic. Okay, so also the pairs you can trade synthetics. That's It's not just only currency pairs alone. You can trade synthetic, you can trade indices, you can trade stocks, you can trade metals, which are gold and all that. So you can trade many pairs, all right? It's not just only currency pairs. All right. So let's go to the beginning of the class now. So candlesticks. So candlesticks basically, when you look at the chart, your chart, they are represented in different forms. All right. We have the line chart, the bar chart, and the candlestick. But many a times we use candlestick because candlestick shows many details of like the price. It shows you many details, like it gives you details, um um informations about what's going on in the market. All right. So the candlestick is you see these red and green candles. These are called candlesticks. All right. So these are called candlesticks. Please, if you are understanding, please just type on the comment. You are getting it. Please, let me know that you guys are following. Please. All right. You can just type on comment. Okay, we are understanding. Okay, candlesticks. All right. So we have two types of candlesticks. One, the bullish candlestick and the bearish candlestick. All right. We have the bullish and the bearish. So the bullish candlestick is the buy candle. Is the buy candle. When I say bullish, price is bullish. That means price is going up. Price is moving up. All right. So when we say price is bullish, price is going up. When we say price is bearish, price is coming down. Do you understand? Bearish is sell, bullish is buy. Bearish is sell, bullish is buy. Please, if you're understanding, please just unmute yourself and say you can, or you can just okay, good. I can see your comments. 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 Good. Okay, all right. I saw your comment, Taiwo. Um, I saw your comment. I saw your comment. Okay. Um, the apps you need: MetaTrader 5, SNES Broker, which you need to create with my link, and also you need
Trading View.
trading view. Yeah, trading view. Yeah. So basically, those are the things you need. All right. All right. So let's continue. So we have in the candle, for example, when the market opens, you have the open of the candle, you have the open of the day when the market opens. And also, let me just chip in this. We have various time frames. You look at the market from various time frames, all right? You can look at the market maybe using your daily time frame or your hourly time frame. That's your 1 hour time frame, your 5 minutes time frame. That means when I say time frame now, each candle for each time frame represents um for example, for 1 hour time frame, one candle is 1 hour. That means another candle appears after another 1 hour. After 1 hour, a new candle is formed. Then daily time frame, one candle, one candle, all right, one candle is 1 day. That means every new day, new candle is formed. All right. So we have the open of the candle, we have the close of the candle, we have the wick of the candle, we have the wick of the candle, all right, and we have the highs and lows of the candle. So you can, as you can see it here, it's very clear. You can see it, all right. You can see it. We have the wicks, we have the low, we have the high, we have the open and the close, all right. Okay, so let me just use this to explain this. When you go to the market, or like layman terms, right? You 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 go to your shop now, for example, you come, let's say you get a goods for 50,000 naira, all right? You bought it for 50,000 naira, and when you open the shop, you're like, oh, I'm selling this goods for 50,000 naira. That's the open price. I want you to get this. That's the open price. And when somebody comes and say, oh, can you just give me for 49,000, and you reduce your price, you gave it that person, and you were like, okay, I'm selling it for 49,000, you sold it, and you're already on a loss though. It came down. That's the low. Let's say that was the lowest price you sold it, and now let's say later on you sold that goods for, let's say, for 55,000 or 54,000, and let's say this is the lowest price you sold it.
Oh, sir, we can't hear you.
Can you guys hear me now? If you can hear me, please say you can hear me.
Yes, sir, I can hear you.
Okay. Good. All right. So as I was saying, I said let's look at this candle. All right. So you see that candle there, right? Let's look at the candle. You see that this is the eye of the candle, which is around 2079, and you see that the low is around where 1910, and where is the open of the candle? The open is below, the close is above, because the candle is going up, so it's a buy candle. That means for one candle in the daily, we have over 24 candles in the 1 hour. I don't. You get what I'm saying?
Yes, sir, yes, sir.
Unmute yourself and all right. Is affecting. All right, so let's continue. So so that's that for candles. All right, so this is V75. You see that one candle here is daily. So these are candlesticks. All right, these are candlesticks. These are candlesticks. All right, so like I said, your charts can also be read using a line. You just be seeing a line, but it's not giving detailed explanation, like it's not giving detailed information of what's happening in the market. So we use candlesticks, all right? Chart patterns, all right? So
Yes, sir.
so chart patterns, I'll be taking three. One is your head and shoulder pattern. head and shoulder pattern. 2, double double top and double bottom. Your chart patterns. These are patterns that occurs in the market, and when these patterns occurs in the market, like um, when they occur, they tells you, okay, this is what the market is going to do when these things occur. Right? So the head and shoulder pattern is like the name implies, is the head and shoulder, head and shoulder, head and shoulder. All right. So you see, this is the shoulder, right? That's the shoulder. That's the shoulder, and this is the head. So when this pattern occurs in the market, it tells us, okay, the market is going down. Over time, that's why it it is called price action. So you
So
it
the network is
when the market
breaking a
forms
bit.
head and shoulder. And it, oh, so sorry about that. But you guys can hear me, right?
Yes, sir. I can hear you now. I can hear you now.
Okay, good, good, good. So for the opposite, for the buy, this is the sell scenario. This is the sell scenario. But we don't trade using patterns, all right? But I'm just showing you that these things exist in the market. So for the sell, we'll everything like this. All right. So this is the neckline. It's called the neckline. And when this rise, this two shoulders, this is the head. And when it's, we're expecting, when we see something like this in the market, it goes up. It's up now and see some this I'm saying. Let's trade basically in, okay, where this market is going and looking at the direct money. This that's right. You know that, okay, this is where the market, this is where you are seeing that the market is going to. Then you take advantage of that direction. I don't know that's what I'm saying.
Yes, sir. Yes, sir.
Do we get? Can you guys hear me? But did you get what I said?
Yes, sir. I got what you said.
Okay, I'll do that again. Okay, the head and shoulder. Then the network is back now. So I was explaining the head and shoulder. Okay, so let me just show you an example of what I was saying. It happens most times in the market, but we don't trade it though. But I just want to show you guys something. Why for the double? Let me just explain so that when I see the double top too, I'll just double top, double bottom. I'll just show you a scenario. It's just basically from reacting to a particular region, and you know when this market is reacting in this kind of region and forms a double top, just know that once it breaks the neckline, it goes in that direction for a long term. I don't know if you get. So also for the opposite. So let me show you from the chart. Let me see if I'll see a clear double top or double bottom. Okay, okay. So I've seen one. You see what I'm saying here. Although we don't use this to trade, but I just want to show you. So you can see this clear region, right? So this a, and there's also a trip. There's also triple top, but this is a clear double bottom. This first touch, second touch, and where's our neckline? This is our neckline. And when price comes back into the neckline, we'll buy. So you see how the market went up in that direction. This is it. Let me draw it well. This this is your double bottom. Came into the neckline and boom. Do you get? Please, if you are getting me, please just comment that you are getting it. All right, please just comment you are getting it. You are getting it. You are getting it. All right. So let's look for um double top. All right. So you can see how price right there. This is even triple top. Price came into that place, came down, came there again, and boom, came into the neckline and boom, came down. Can you see it? So basically, you over time we have seen that triple top, double top, they are they are everywhere in the market. They are everywhere in the market. So you see that region, all right? Me, I want to trade this thing now. I will not be I will not be even interested on in the sell. Instead of this interest me being interested in the sell, I'll be interested in this buy to take out this triple top as liquidity. Also, look at this double bottom. When price takes out the neckline, we are buying to that region. I don't know if you are getting me. Please, if you are getting me, this is it. This is a clear buy signature. Double bottom came into the neckline again, and boom. This was what I was explaining. Double bottom came into the neckline, and boom. All right, please. Okay, okay, okay. Getting it right. All right. So for candles, you need to understand chart pattern. Just know that there are some. If I don't use chart patterns, but I only use it as like liquidity. I use chart patterns as liquidities. All right. I use chart patterns as liquidities. So this for candlesticks. and also, okay, I stated swing point, swing point. Let me explain what a swing point is, because we need it. All right. So let me explain what a swing point is. Let me explain what swing point is. Right. You guys can see my screen, right? So a swing point is a theory price whereby the count. All right, something. All right, I'm back. I'm back. Network. So okay, so you can see. So these are, we have. Let me go back. So chart candlestick patterns. We have the bullish engulfing candle, and we have the bearish engulfing candle. Like the name implies, the bullish engulfing candle means the bullish candle is engulfing. In the market, but it means the bullish candle is engulfing the bullish. All right, it means the bullish candle is engulfing the bearish. That means it's bigger than the bearish candle, the green candle. The green candle is bigger than the red candle. For bearish engulfing, the bearish candle is bigger than the bullish candle. All right, please, if you understand so far, please just unmute yourself and say something that you are getting me, so that I will know that you are following.
I'm getting you, sir. I'm getting you, sir.
Okay, okay, okay. Great, great, great. So the bullish engulfing, let me just show you from the chart. Let me share my screen. Let me show you from the chart. From the chart. So when they say bullish engulfing, that means the bullish candle is engulfing the bearish candle. For example, we saw that there. So you can see that this bullish candle, the green candle engulfs the bearish candle, right? When you say bullish engulfing or bearish engulfing, the bearish candle is engulfing the bullish candle. Look at the bullish candle, the green candle, and look at the bearish, engulfed it. So most of the time when you see this pattern, that means the market wants to sell. That means the selling pressure is high. So you saw how the market came down because of this signature that happened there. All right, I don't know if you get that.
Get it.
Okay, good, good, good. So for so like I said, chart patterns. We have the I don't do chart patterns, but I just want to show you so that you know that oh, these things exist. We have many chart patterns, but the major forex reversal patterns, we have the head and shoulder, double top, double bottom, and all that. So those are the major things. Those are the major ones. You just need to learn them, take note of them, write them down. We have the double top, double bottom, head and shoulder, inverse head and shoulder. We have the those are the key ones. All right. So going to the main thing for tonight's class is market structure. So market structure basically shows or is the way the market moves. The way the market is moving up and down, that is market structure. So we have the market structure is now broken down into uptrend. The market moves in three ways. It's either moving up, down, or sideways. And these things are called trends. Trends. When the market is going up, it's called an uptrend. When the market is coming down, it's called a downtrend. When the market is moving sideways, it's called a sideways trend. I don't know if you get that. If you get that, please unmute yourself and say you are getting it. You're getting
I'm
it so
getting
that
it,
we know that
sir.
you're following. Good, 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 good. All right. So we have the uptrend, downtrend, consolidation, which is also a sideways trend. All right. So this is one of the basics of trading. You need to understand how to do market structure. That's why we want to take our time to do this because market structure is basics, is one of the foundations of trading. All right, so I'll share my screen and let's all right. So all right. Let me just delete this and start again. All right, so you can see, as you can see, the market does not just move when the market wants to go up. It doesn't just move up like this once, or when the market wants to come down, the market does not just move like this down, or when the market wants to move sideways, it doesn't just go on a straight line. All right, the market tends to form.
Yes, sir.
The market tends to form, like you can see, the market tends to form when the market is going up. For an uptrend, write this down. For an uptrend, the market forms series of higher highs, higher lows. All right. For an uptrend, the market forms series of higher highs, higher lows, higher highs, higher lows, higher high, higher lows, higher high, higher lows, higher high, higher lows, higher highs. You get that? So when the market
Yes, sir.
is on an uptrend, the market forms series of higher high, higher low. This is one of the foundations. Please, you need to take note of this. So you can see it. The market keeps on forming higher high, higher low. Why do you say high high? This high is higher than this high, the previous high. This low is higher than this previous low. Do we get that?
Yes, sir. Yes, sir.
All right. So we have series of higher lows, higher lows, higher lows, higher lows, like we saw. All right, can you see slide? So in the slide, you higher low, higher high, higher low, higher high. When this higher low now breaks, forming a lower low, that means the market has, when this market breaks the lower low, the higher low, it now forms a new lower low. That means this low is now lower than the previous low. That means the market has shift structure. There's a change of character. There's a change of character, right? There's a change of character. You see, higher low structure broken when price makes a lower low followed by lower high. All right. So you will now know that the market has changed trend. And when the market is let me go back. All right. Let me go back. When the market is coming down, from series of lower low, lower high, lower low, lower high, lower low, lower high, lower low. Just like that. Lower low, lower high, lower high, lower low, lower low, lower high, lower low, lower high, lower low. Do we get that? This is the foundation. You need to understand. Please unmute yourself and talk. Unmute yourself and talk. Unmute yourself and talk so that I will know that you're following. Okay, great, 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 great. Okay. So when a clear direction, we just have the market just consolidating like this, sideways, like this, like this, like this. It's called what? Market is sometimes we say the market is choppy or is in a consolidation. Can you see? So these are the various ways the market moves, and you need to master this. You need to master this. Once you master this, you will you have at least started your journey. Mastering market structure will help you to will help you a lot in trading. Knowing the direction of the trend, you hear forex traders saying follow the trend, follow the trend. That means following the trend, you know where the market is going to, and you want to bank on that direction. As the market is forming higher highs, you are buying from the higher lows, you are buying from the higher lows, you are buying from the higher lows, same way. All right. So let's go to our chart now to do some markups. All right. So I'll go to we'll do market structure from the daily time frame. From the daily time frame. So for a bullish market structure, we said the market forms what? Series of higher high, higher lows, right? So I want to ask this question now. What's the market doing here? Is it moving up or down? What's the market doing here? Is it on an uptrend
It's
or
moving up,
downtrend?
uptrend.
It's moving up, right? Good.
Yes,
Uptrend,
sir.
uptrend, good. Yeah, this part, what's the market doing? Coming down, right?
Downtrend. Yes, sir.
Good, good. All right. So you see, in this downtrend, the market did not just come down, boom, straight. The market formed series of lower low, lower high, lower low, lower high,
Lower highs and lower lows.
lower low, lower high, lower low, until this shift forming higher high, higher low. I don't want to mark all these stuffs, right? But I'm following the overall, looking at it overall. Higher high, higher low, higher high, higher low. higher high, higher low, then higher high. Do we get what I just did, right? Did we get it?
Yes, sir. Yes, sir.
So you have to see you have to mark out your structure. You have to know, okay, see, in fact, you have to mark everything. You can see when this shift occurred here, when that shift occurred here, eh? When that shift occurred, right? When that shift occurred, you know that now the market is not going down again. It has changed. It has changed trend from downtrend to uptrend. Because if the market is coming down, it should keep on taking out the lows, like we saw. Let me show you. Like we saw from this slide, you see that the market should keep on taking out the lows. If the market is on a downtrend, the market should be taking out the low, the low should be taking out the low. But if the market is not taking out the highs, that means the market is not now on an uptrend. The market is now on an uptrend. All right, market is
Yes,
now
sir.
on an uptrend. So you will know that overall now you are bullish, but minorly what happened, we saw that the market was forming minor downtrend in an uptrend. Overall you're looking at it uptrend, but it formed minor lower high, lower low, lower high, lower low. I don't know if you are getting what I'm saying.
Getting you, sir.
Until it now came into the overall by breaking out the structure to continue the overall trend. Broke out that high, continuing the overall trend. But meanwhile, you know that the market should take out this overall high because your overall is uptrend. All right, so let's do more mark out. Let's do more mark out. So the market was going up, forming series of higher low, higher high, higher high, higher low, higher high, higher low, higher high. Broke out that high. They now took out the low, forming a lower low. That means you should know that now you are now on a downtrend. This is the daily time frame. You are now on a downtrend. The market started forming lower low, lower high, lower low, lower high, lower low, lower high, lower low. Do you get what I'm
Sir,
saying? See,
sir, I'm not seeing the chart.
okay, sorry about that.
Yes, sir.
Okay, so you can see the chart now. This was because I was marking out. I said the market was forming series of higher high, higher low, higher high, higher low, higher high. Now change. There was a change there. It broke to the down. That means you're not expecting the market to go up again. It has now changed trend from uptrend before to downtrend. So it's now forming series of lower
Yes.
low, lower high, lower low, lower high, lower low, lower high, lower low. You can see how the market fell because of you could have made a lot of money if you have sold this market from this region, because you saw the change and you'll be selling from the lower high, you'll be selling from these regions, which we don't go into when to sell or what to before you enter a trade, um, what to do and all that. But I just wanted to understand this structure, how to mark out this. So currently, I want you guys to see something. Currently, what's the market doing? Market is on a downtrend.
Downtrend, yes.
The market is coming down. You can see since it has been coming down. It's taking out the lows. It's taking out the lows. That's why the market is still coming down till now. That's why the market is still coming down. All right. So, and you need to understand that for the daily time frame, when the market is on an uptrend, the main trend direction, right? The main trend direction is this leg. This leg is called the impulsive. This leg that is here, it's called the impulsive move. Impulsive move, retracement, impulsive retracement, impulsive retracement, impulsive retracement. So if you are on the daily time frame, right? If you're on the daily time frame, you will see this as just maybe three candles going up like this. But on the 1 hour, you will see it as this.
Yes, sir.
Do you get what I'm saying? You will
Yes, sir.
see majorly we look at structure from higher time frame because that's the main drivers of the market. That's the main drivers of liquidity. That's where market makers like they follow directions of higher time frame. You understand? So, but when you go to the 1 hour, this leg you are seeing here that is like this. In the 1 hour, you'll be seeing it as minor, um, minor structure. So, for example, let me just show you this. For example, okay, I'll just want to look at this leg. This leg that happened here. So let's just mark out the structure. I want you guys to follow me as we're marking out this structure, right? So we have the market was forming lower low, lower high, lower low, broke that structure, higher high, higher low, higher high, higher low, higher high, right? Higher low, higher high. Then now change lower low, lower high, lower low, lower high, then lower low. Can you see?
Yes, sir.
Do we get it?
Yes, sir.
So if you can do this, I tell you the truth, you are on your way to success in trading. This is this is the first thing you need to understand, how to mark out structure. And we use the trading view because it has a lot of features that will help you to mark out these things easily. So like I said, this daily time frame leg, we want to look at it on the 1 hour time frame. And you see that it's a minor bearish structure. It's a minor bearish market structure. You see it. Coming. So on the 1 hour time frame, that stuff we mark out. Let me show you. That leg we marked out. You see from the top, you see that it not just come down. It was forming
Higher low, lower lows and lower highs.
lower low, lower high, lower low, lower high, lower low, lower high, lower low. Just like that, the market will be forming minor. Do we get what I'm saying?
Structures. Yes, sir.
Minor structures on a major leg. That one is not too clear, but let me show you this. You see, this is the daily we marked out, all right? So in that daily time frame, minorly, we were seeing the minor bearish, higher high, higher low, higher high, higher high, higher low. Do we get what I'm saying?
Yes, sir. Yes, sir.
Just like that. So this we do market structure on the daily time frame. On the daily time frame. Let me go back to the slide. All right. So look at what I was saying. This is the illustration of market structure concept. So you look at it where you see that the long term, in that long term, there are minor bearish candles, minor bearish candles. Please, if you understand what I'm saying, please just you know
I understand what you're saying,
see
sir.
you are getting me. Okay, so you can see that in this leg
I'm
we
getting you,
have
sir.
minor so what we do is daily time frame will go market structure. So one of the things I want to give the first assignment, you just go to trading view deriv. All right, since we'll be trading, for those of us that want to trade currencies, you can also go to trading view, just your plain trading view, where you'll be seeing currency pairs like your euro USD, GBP USD, and all that. Go to those pairs and mark out. So the first assignment is take note. You mark out structure. Go to your daily time frame. All right, the daily time frame. Mark out euro USD, GBP USD. Then for the VIX 100, you do the VIX 100, you do VIX 75. So just back test like you see where I'm going back. Go back and mark out structures and send it to the group. Do you get what I'm saying? What I just said? Do we get what I just said?
Yes, 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 sir.
So the assignment
Yes,
is
yes, yes, yes.
assignment is go to your chart, your trading view. If you want to see the synthetics, which is the volatility, 100 volatility 75, you will go to trading view deriv. Trading view deriv, and you see that
All right, sir.
volatility pairs. And also your trading view, the normal trading view, you will see your euro USD and all that. You see them there. So do the markups, do some markups, and send it to the group. Practice these things. That's the only way um, to understand these things. We are moving. We are moving. This is slide 9. Or we should do one. Let's do one currency pair so that you still understand this forex. You can also see forex here. So let's do euro USD or GBP USD. Let's do GBP USD. Euro USD and GBP USD, they are very like they are like.
You know.
You can also see in this report. You can also see your GBP USD, your currency pairs. Come in. Let me share it. So I'm trying to load it now. So this is the GBP USD. This is the GBP pair. Can you see it?
Yes, sir.
So let's mark up from here. So you see what you see this clearly. See this clearly. So clear. In fact, this kind of market when it's clear like this is very sweet because you can make a lot from it just following the trend. So we saw that the market was just going up, forming series of until we saw that the market came down, broke that trend, right? And started forming lower low, lower high. Can you see it?
Yes, sir.
It's so clear. Can you guys hear me? It's so clear.
Yes, sir. Can hear you.
So you can see what happened. The market keeps on taking out the lows, keeps on taking out the lows. The market keeps on taking out the lows. All right. So this brings
Yes,
us
sir.
to our demand and supply. This brings us to our demand and supply. Hope you guys can see the slide.
Yes, sir.
So like I said the demand of a particular product makes the price of that product go high. All right. So you can see when the market is going up, it is moving from a demand zone. There's a demand zone moving that price up. When the price is going down, there's a supply zone moving the price down. So look at it. You can see from this side, you can see that in this structure, the price is majorly moving from the demand zone, the demand zones, right?
Yes, sir.
Right? You can see it. So let's go to our chart to see something. So this the opposite, right? This supply zone. So how do you know? How do you mark out your supply zone? Let's use this leg, right? This leg. All right. So if you go further, you see that they said the two factors you should pay attention to. One, did it create inefficiency? That's IFC. IFC is inefficiency. That means it's basically fair value gap. Did it break structure? Did it change character? So before that, let's talk about um break of structure, change of character, these terms. All right. So when the market is going up, the market keeps on taking out the eyes, right? So when the market takes out the eye, so when the market takes out the eye, all right, takes out this eye, forming a a new eye, right? That thing, that is a break of structure. So let me put it there so that you understand. That line, what happened there is BMS or BOS break of structure, right? Do you get what I
Sir.
just said?
Yes, sir.
This when this eye breaks, the break of structure, another break of structure will be here again. Break of structure, break of structure, break of structure, until when the market now change. That's what we call change of character. So when the market keeps on breaking out that eye, can you all see the screen?
Yes, sir.
All right. So this is break of structure, break of structure, break of structure. All right. So this is break of structure, break of structure, break of structure, break of structure, until when the market now change. That's what we call change of character. So when the market now change, break of structure until this point where the market changed from an uptrend to a downtrend. That's what called CH, change of character. Change of character. That means when the market forms, changes trend or changes structure, it's also called shift in market structure. Is change of character. There's a change of character, right? Do we get that? So, like
Yes, sir.
I
Yes,
said
sir.
a demand zone, a market moves from a demand zone. Every market moves from a demand zone. It's moving from a zone. There's a demand zone. It must not necessarily be at the extreme, but there's a demand zone causing this small price to move up. Also, now there's a supply zone causing the market to move down, just like that. So after you understand this, then you can now understand this, that when you say did it break structure, you need to understand, okay, the supply zone that you want to mark break structure. So let me go back. You can see how they mark that demand zone. After the market has broken structure, they mark out a zone where the market will come back into, and now they will now buy from there. Same thing here. Same thing here. Same thing here. You have not seen this part of the market. Let me just take that out. Let's say you have not seen this part of the market, right? This is where you are seeing currently. You have already marked out the structure, okay, it's on a downtrend, right? You already marked out the structure that, oh, I'm on a downtrend, right?
Yes, sir.
So now what they are saying is you mark out zones, right? I don't want to teach you guys other block now, but I want to just say demand and supply zone, right? So you mark out zones that are valid, all right? Zones that are valid. So looking at this leg, you see that there's a gap here. Before this last candle, that candle here is your supply zone. That's the first one. This is the second one, which, yeah, that's the second one. So you can see that there's a gap. There's a gap. There's a gap there. Can you see that gap?
Yes, sir.
When I'm teaching fair value gap, I will explain that gap better. But there's a gap there. So that one is the most efficient supply zone. Can you see how price came into that zone, and you will be selling from that zone because you know that the market is taking out the low. The a downtrend is forming series of higher lower low, lower high, hitting this previous low. So when it comes into that your supply of the or your supply zone, you should target the previous low. You can see what price did. Imagine we sold from here, we sold from there, we placed a trade, we sold, targeting the old low, and yeah, can you see that?
Yes, sir.
So the rules you must follow the rules. Okay, Emma said I should come again for the supply and demand zone. Jude, you are here. Welcome, bro. I just saw you. I just saw you.
Thank
So
you,
the
bro. Thank
demand.
you.
Okay, that's one of our team member. He's an analyst. He's a beast. Welcome, bro, welcome. Also, Emma said that you explain the demand and supply zone again, so which I will do. Which I will do. So, like I said, every market reacts from a zone. If the market is going up, I said when the demand of price, when the demand of price goes high, the price of that goods when the demand of a particular product goes high, the price of that product goes high. So you need to understand that. So when the market is moving up, the market is moving from a supply zone or a demand zone. So if the market is going up, break or so after the break or so, when the market comes down, you should be expecting that the market should move from a demand zone up again, from a demand zone up again, from a demand zone up again. The demand zone can either be a buy candle or a sell candle. Take note of that. It can either be a buy candle or a sell. I'm not teaching you other book. I'm just teaching you buy candle, sell candle. Demand zone, supply zone. It can be any of the candles. It does not matter. But what I'm saying is, it should be, it should have what a inefficiency. That there should be a gap before that block, and it should break structure or change character. Then that is when the zone is valid. That is when the zone is valid. So, like we did, yeah, we saw that this one was the most valid one because one, there was a gap. There was a gap here. Remember, this is GBPSD. There's a gap, and that gap needed to be filled. And now we sold down. We sold down. Do we get that? Do we get that? Can you guys hear me? Can you guys hear me?
Yeah, we can
Just
hear
say
you.
can hear me. Okay, great. So those are the things you look out for. You need to check. Okay, did it break structure? Did it form? Is there any inefficiency in price? Then and all that, and all that. All right. So let's see another example. How to, let's see an opposite example, right? For the buy scenario. So we saw this break of structure to the up, then it came into this demand zone and it went up again. So after that break of structure, right? After that break of structure, we saw that the demand zone was this candle. You can mark it from the wick of the candle to the using the wick of candles, right? So when price came into that demand zone, what happened? Tapped in and went up. You can see that. Did it have inefficiency? Yes, there's inefficiency. That's the fair value gap
You
attached to
can't
it.
see it.
This is
You
it.
can't see it.
This is the fair value gap attached to it. I'm saying a lot of things here, but then again, this is it. We saw that shift to the upside, and it came down into that demand zone and went up. Boom. Can you see that? Can you see that? So I'm saying that the demand zone can be either buy candle or sell candle. But what you should do is there should be a gap that's inefficiency. I will explain this in our next class. That's fair value gap. All right. I'll explain that well in our next class. But for now, um let's just do what we're doing. Let's just okay. So what I want us to do now, currently, now, I want everyone to go to their charts, right? Go to their chat. Okay, let's do one pair. Let's do one pair. I think we'll soon end the class for today because obviously time is fast spent. So almost all of us here go to trading view deriv. Trading view deriv. Let's do one market structure analysis on let's do one market structure analysis, right? Before we call it a day. And I think we did a lot. We did a lot today. I hope you guys learned something. I hope you got something. So I want you guys to tell me, this is the last thing I'll teach for today before we go. Okay, so take note, write it down, write this down. We use candle wicks for structures. We use the candle wick to mark out structure. So what I mean by that is, after marking out your structure like this, the wick of the candle, that's where you mark out as your higher high. For this scenario now, higher high. The wick. Why we use the body for break of structure. So before you can call this bar that happened here, pushing up a break of structure, is when the body close above this eye. Do we get that? So for example,
Yes, sir.
we will not say this when this price came down, broke here, because there was a candle closed below the old low. That's why we can say that's a break of structure. It broke down, closed the candles. There was a close. Let's look at this. The first candle that first closed did not close below the low. So we can't say is it. Okay, let me delete that line to see the exact point. Okay, that's low. So you see, this was when we had that break of structure. When this candle closed below the low. So I'm saying we use candle bodies for break of structure, and we use candle wicks for structure. Like you see what I did when I was marking the structure, I was using the top of the wick of the candle. You see it? I'm using the wick.
Yes, sir.
The wick. You guys can see my screen, oh.
Yes, sir.
All right, so I'm using the wicks for. So take note, we are using wick for structure, and we're using candle body close for break of structure. All right. So I want all of us to go to our chart now and mark out what's currently happening on this 100. Let me, where you mark out from, you start from, just mark out from this region to where price is currently. Mark out the structure, the higher high, let me show you what you do. Higher low, something like this. Mark it out. So, can you see what I did, right? Did you see what I did? The tool you are going to use, this is the tool, the parts, the part.
Yes, sir.
Can you see this part? That's what you use to mark out this thing I did. So let me show you something why I said we use wicks for structure and we use candle bodies for break of structure. Looking at this market, the market is on an uptrend and we want to be buying on this uptrend. But you see, when the market took out that high, when the market took out that high, what happened? There was a candle close above. There was a candle close above, right? When the market came down, is this a break of structure? Is this a break of structure? The candle did not close, the body of the candle did not close below this low. So it's not a break of structure. That's why you saw that the market did not. Some people take this as, oh, break of structure, and they will now be selling, wanting to sell because they thought, oh, the market. But there's no candle close. There's no candle close below this low. So it's not a break of structure. That's why we continued up. That's just a liquidity. They just grabbed liquidity and price closed. The closed traders that they buy and they now started buying. So they will think, oh, you not think if they're selling, you sell, they will take you out. I hope you guys are getting what I'm showing that.
Yes, sir. Yes, sir.
So we mark out break of structure using the wicks, the wicks of the candle, and we use mark out structure using the wick, and we mark out break of structure using the body. So that's the we'll be ending to this class because our time is fast spent. So you go to your chart, mark out from 25th of 25th of September 2023 to the current price for this 100. For this 100, mark out the structure and observe. Also go to your 1 hour to observe, okay, what's going on in that leg and all that, and something that we did. All right. So we'll continue tomorrow, right? So summary, we talked about candle, talk about candlesticks, right? Talk about candlestick, talk about candle pattern, talk about market structure, talk about chart patterns and all that. So please, you can also see go through the video. It will be on YouTube. It's live on YouTube. You can watch it so that you can go through these things again and understand. And if you have any question, please ask on the group. If you haven't joined the group, join, ask on the group, and let's analyze, let's work. Because I tell you these things, even if you learn these things and you don't practice these things, you will not see results because you have to practice these things for yourself. You have to see these things. You understand?
Yes, sir.
We're not right there.
Yes, sir, I'm here.
Okay, all right. So thank you so much, guys, for joining. Please, that assignment I gave, those assignments, I said one, go to Euro USD, mark out the chart, the market structure, and tell me, okay, this is the direction from your daily time frame. This is what you are seeing, that the market is on an uptrend or downtrend. And also go to GBPSD, do the same. If it's 100, do the same. If it's 75, do the same. So those are the assignments. Drop it on the group when you are done. Thank you so much for joining, and we'll see tomorrow.
All right, sir. Thank you very much.
Thank you so much.